What's up, everybody? This is Misael Gonzalez. You're watching Wall Street Saturday, a show about God, investing, and stocks. Our show is for educational purposes only. We're not financial advisors. So go ahead and enjoy the show. Share it, like, subscribe, and hit the notification bell to be notified every time a new video comes out. Thank you.
Hey, what's up, everybody? Thanks for joining us for another Saturday, a Wall Street Saturday, September the 24th. We have a fun video for you. Before we get too far ahead, I'm Josh Flores.
I'm Joshua Trusty.
And this is Misael Gonzalez. So before we start, let's just get in a quick prayer. Lord, thank you for this day. Thank you just putting us on this earth one more day, that you would just give us a fruitful day. And thank you for allowing us to gather and talk about the stuff that we love. So we give you thanks and we pray this in Jesus Christ's name. Amen. All right, so for today, we've been talking about, how Jerome Powell has been way too lenient on the money supply, and it's kind of put us in this really bad spot now that we're trying to turn ship around. There's this particular guest on CNBC that likes to come in and give his point of view. He's from the Wharton School of Business. His name is Jeremy Siegel. And I'll just play this video and we can react to it as he talks. But I think he has a lot of sense when he says that the Fed kind of messed up this time.
What are your thoughts as we watch these lows of June at least be taken out from the Dow standpoint, and maybe in the days ahead we find the other major averages in this same precarious place?
Yeah, certainly. Scott, I find it very amusing. A year ago at that September meeting, when we had booming commodity prices, when housing prices rising at the fastest rate in post-war history, when we had all commodities going up at rapid rates, Fed Chairman Powell and the Fed said, we don't see any inflation. We see no need to raise interest rates in 2022. Now, when all those very same commodities and asset prices are going down, he sees, stubborn inflation that requires the Fed to stay tight all the way through 2023. Makes absolutely no sense to me whatsoever.
So that's like the first half. I think what he's saying there is that, back when we had very obvious signs of inflation in the market, kind of, he points out like the commodity markets were pretty high back when it must have been like middle of 2021, where like lumber for housing was really up, and a few others, right? I mean, that's when we should have had action from the Fed, and the Fed said no, everything's fine. So then he continues on, but it just gets like really intense here in a second.
Yeah, we do not have to get anywhere near that level to stop inflation because.
Wait, you were saying, Josh?
Yeah, I was just going to say that that was just like a year ago, but it feels like even longer period of time. Because I even remember back then, like the term that the Fed was using to describe inflation was transitory, and that's what we thought. A lot of these supply chain issues that were occurring were going to be just like were purely solvable just by like more intelligence, like more things coming back to normal as like more workers like started going back to work. But it turns out that a lot of we've had even more headwinds to the supply chain, like the war in Ukraine, as well as like increasing oil and gas prices. So a lot of like those things didn't turn out to be so transitory at all, and indicated there was like a fundamental drive in and power from the consumer in being able to drive up like the demand, so that the supply chain just could not and still is like struggling to supply that and to meet that demand.
I think some of the China shutdowns were a little bit longer than we anticipated as well. And, I'm not crazy about how important China is. With that being said, I think that they are extremely important. Obviously, I think they have 60% of the world's manufacturing. I could be wrong about that. I'd have to fact check that, but I know it's a significant amount of the world's manufacturing. So when it was shut down, obviously that bottlenecked some of the some of the things that we were needing here in the US. And so I just that, of course, they printed all that money, during that time, and now employees are demanding a lot to be paid for. I mean, there's a lot of people getting paid a lot of money really just to do nothing these days. But
Let's
yeah.
see what else he has to say real quick. I think he gets into the housing market here in a second.
Oh, the inflation is basically stopped. It's basically stopped. I mean, you had a headline just came across 3 minutes ago. Oil back to January levels. That's before Russia invaded Ukraine. You can see what's happening to commodities. We're going to get the Case-Shiller index next week. It's going to show no increase or a decrease for the first time in years. And that's a lagged indicator. On the ground, commodity, all the prices are going down. The only thing that's not going down is wages. And by the way, wages are in catch-up mode. Don't argue they're pushing inflation. They're lagging inflation. I mean, the workers are trying to get what a little bit back of what the inflation happens to be. I think the Fed is just way too tight. They're making exactly the same mistake on the other side that they made a year ago.
There are those who agree with you, who think that the Fed is oversteering.
Yeah,
but
absolutely.
But saying it doesn't do anything for the scenario that we're currently in. If they continue to do it, whether you think it's right or wrong, if they continue to do it, what does it mean for stocks?
Well, until he sees the light and says, you know what, I don't think we have to be so tight. Until that happens, you can still have pressure on stocks. I mean, and that's gonna, that's probably one of the factors that can see the light. I mean, when he sees how high real rates have gone, the dollar the highest in 20 or 30 years. By the way, next Tuesday we're going to get the monthly stock market money supply data, which is going to show the greatest decline in 5 months that we've had in the post-war period. I mean, if he looks at any of the money.
So I'll stop it right here, but just to point out something that Josh Flores was saying, I think in regards to the wages, right? So we've seen companies get record profits, but the actual employees themselves are barely still fighting for, some of them $15 an hour as a minimum, while, these companies make a lot of money, which is the point you were trying to make, right, Flores? So anyway, but I wish they had brought up the 2-year note, which is something that was in the news this week, which was was up back above 4%, which hadn't hit 4% since 2007, and that's what we talked about probably like a year ago. We're saying stocks are hot because interest rates are low, nobody can make money in bonds, and now all of a sudden there's this opening for people to be in way less risk in stocks and actually make money. And so we're seeing that capital flight away from equities into bonds, which is driving, actually, kind of driven by, the interest rate hikes that Jerome has kind of implemented. And so we're seeing 10-year note, 2-year note, like even the 30-year, notes are like way up because now there's an opportunity to kind of make money that way. So let's hear what, unless Trustee has anything to say, we can hear what he has to say about the housing market.
Yeah, and also one thing I just wanted to note was that the fact that the 2-year note is now above 4%, whereas like you can see in the video here, the yield for the 10-year note is 3.711%. That's also what we call yield inversion, which I think we've talked about on the show before. But essentially what it means is that investors see short-term risk being greater than long-term risk, which should disturb you as an investor, because that means that in the short term, there's higher risk. So there's something that might indicate that there could be a recession on the way, in that if the 10-year note has less yield than the 2-year note, that might indicate that maybe there's a recession in the short term, but over the long term, things will recover. So it's always like a bad sign when long-term risk is less than short-term risk, because intuitively, the longer time window you're looking at, the more things can happen, and the more things can happen, the more risk. But in this case, we're not seeing that intuition play out in practice. So that's just another sign that
financial indicators. He can't say, oh, we have to keep them on. I mean, at his press conference, he said, we have to get real rates into positive territory. They're in positive territory for every maturity. For the first time in years, we're already there. I mean, I thought that was the most uninformative. I mean, and no one was asking him a hard question. How do we have 3.2 million new workers and GDP going down? What does that mean?
Hey, there it is. Oh man, yeah, it's well over 4% in the 2-year note. Even the 5-year note is larger. That is that's very interesting to see. But he brought up my point, right? About the employees. But there's I think that we have like the lowest employment like in years, like of almost, I don't even know how long it's been, but yeah, GDP is going down. Obviously another sign of a recession. Obviously the 2-year and the 5-year being over the 10-year, obviously another sign of a recession. This happened, I think, in almost all recessions that we've had, and depressions for that matter. But just an observation. I'm not saying that it will happen. It's all speculation at this point.
What does the record decline in the money supply mean? I mean, what does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation, which are going to filter through inflation for the next 12 to 15 months? Is that what he's looking at? Why is he looking at that? That's not an accurate view of what housing inflation is. I mean, there were no hard questions. There were 50 reporters there. I don't know. They basically said, repeat the statement you made at the beginning. There's so many things I ask him. What is he actually looking at? I mean, he's looking at 3-month annualized core inflation that is a lag. Well, we all look at market. I mean, look at what does the stock market do? It looks at market-oriented data. And that's what
Professor,
the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy.
It's rough, man. It's really rough.
Yeah, I think the main point that he's trying to make is that 2020, 2021, I mean, we had COVID, but now that we actually have like things that could for sure drive inflation, that's even out of Jerome Powell's influence because of the war, because of China, because all this stuff. Now he's been really aggressive. So he's being aggressive at the worst time he could be aggressive. And that's just going to be like a recipe for disaster.
I mean, I think in some sense it's strangely consistent with like the Fed's like approach to fighting inflation. There's been like inherently a lag to begin with, because they should have like begun raising interest rates earlier than they actually did, and now it seems like they're continuing to raise interest rates more aggressively when it's kind of when they're basing that decision on lacking information as well. So I think it's there's just a lot of pain in terms of that's being caused by the timing is just like off like for the Fed. So yeah, that's just kind of my take on it.
So to me, I think it kind of begs the question, right, from the professor. What is it that Jerome Powell is actually trying to do for us? Like what is the Fed's goal at this point? I mean, I was thinking about it this morning. Typically, what they say is, you buy the rumor, sell the news. But it really seems like these days, because the market is kind of going in a different direction, you almost want to sell the rumor and buy the news, right? The rumor is that Jerome Powell says that there's going to be there's most likely not going to be a recession, but I think people are saying that, he's saying that there is, right? So people are selling. Then when it doesn't, people want to buy right? So it's a little backwards to me, right? Obviously, this whole thing has been backwards to me, honestly. Typically, when there's economic downturn, they lower interest rates, but now there's economic downturn and they're raising interest rates. So it's all backwards. I feel like we're playing a game, we're playing a football game, and the opposing team just completely switched their strategy on us. And I think that's what's been hindering me just the past year, honestly. This whole actually not the whole year, but since January, right? That's why I'm getting like confused and why I think it's getting harder these days just to kind of figure it out, at least going long.
Yeah. Well, just to answer that question, it says right here, the main mandate of the Fed, right, is to pursue the economic goals of maximum employment and price stability, which at the moment seems that's an impossible task, because from what Jerome has been saying is that we want to, the labor market to take a hit, and then in doing so, hopefully bringing inflation down, which would mean price stability, because at the moment we have like a lot of up and down, up and down, up and down.
Mm-hmm.
But see, not having enough people to do the jobs in itself causes inflation. So you add to that the fact that we have this thing going on in the war in Ukraine, and you have like political strife between manufacturers and where those parts are coming from, Asia, Taiwan, whatever. I mean, it's just impossible. I mean, I think there's so much that Jerome can do on this side of the world because of the mandate that he has. But at the end of the day, there's going to be some of those things that he just can't control, and they're going to, just kind of drive the markets a little bit. So, yeah, I mean, I think for us, right, like thinking about having like an investment horizon, if we're looking 20 to 30 years, it's a great time to buy equities. So, and my mom, right, who's just about to retire, I mean, she's doing great. Bonds, people who are in bonds are like doing great at the moment. So I think it's just up and down, up and down. So we just need to stay focused, make sure that you don't spend more than you earn, and always keeping a stash of savings. So any final thoughts, guys?
Yeah, I mean, just last thing, I think what you said was like really, really perfect, really spot on. I think that investing for today, if you invest anything, you should probably be prepared to keep that invested for a while. I don't think short-term gains are like really the strategy right now. I think anything, I mean, of course, this is a group that's always thinking long-term, but in case there's anybody out there listening that's looking for a quick buck, this definitely isn't your market. But that's the only thing that I wanted to say.
Yeah, very well said. I think like if you really want to mitigate risk, you can consider just having a diversified portfolio in both equities and bonds if you can't tolerate a lot of risk, which in the market is pretty volatile at this point. But what you don't want to do is sell, because like once you sell, then you've committed to those losses, and we don't want to lose money, right? We're trying here at Wall Street Saturday, as ever, we're trying to stay long and stay green.
Hey guys, thanks for checking out the video this week. If you haven't already, please like the video and subscribe to the channel. Every week we're going to be uploading a couple of videos every Saturday of opportunities that you can take advantage of in the markets. Thanks again and have a happy trading week.